You are listening to chartingwealth.com for Tuesday, the 16th of June, 2015. Have you always wanted to know how the stock market worked and why? Well, here at chartingwealth.com, we make it easy. As you're going to see every day, we track the total market, the S&P 500, the NASDAQ 100, and gold. We show you what's happening and why. So all you got to do is sit back, relax, and learn how the market really works and figure out how to make your millions. Now, we are not a stock calling service or a financial advisory firm. Our opinions are our own and are in no way to be taken as financial advice of any kind whatsoever. Let's look at IYY. What is that? That is actually the total market fund. What have we seen it doing since the 22nd of May? Well, it rolled over and started going down on our two-day chart. Now, toward the end of last week, there was some movement on the 4-hour chart for an up move. And of course, people who get scared when they see up moves on 4-hour charts, smaller charts, might have gotten out thinking, oh, I need to get out because everything's moving up. What did we say? We said that the 2-day chart had not yet turned over going up. And what do we follow? We follow the bigger chart. Now, the small chart helps us in a number of ways figure some things out, but we did not see the 2-day chart turning over. And guess what? If you would have gotten into the 4-hour chart, you would have gotten in somewhere around where it topped off, and then you would have lost considerably. What has happened? Well, the 2-day chart has continued to move down. In fact, it went down today. The 2-day chart has continued to move down. The derivative oscillator moved down today along with the MACD after it crossed over back between the 28th of May and the 1st of June. We are still in a down move for the total market. Now let's see what's going on. We'll stay on the 2-day chart, but we're going to go over to the S&P. That's SPY. Again, it is a SPDR S&P 500 ETF, exchange traded fund. It crossed over between the 28th and the 1st, going down just like the total market did. Remember, the S&P 500 are 500 big companies. They're not the whole market, but they're a big weight of the market. So many times it tracks the total market, and it crossed over going down between the 28th and the 1st. It's continued to move down. We saw the same kind of movement on the 4-hour chart where it ticked up starting on the 9th, the morning of the 10th actually, moved up through the 11th and then crossed back over going down through the 12th, went down substantially the morning, that is this morning, of the 15th, and recovered a little bit in the afternoon. Overall, it was down 0.43% for the day. We're below our 2-day trend line. The market also on the 4-hour chart, the S&P 500 crossed over going down. So again, big charts rule. 4-hour charts can help us, and again, if they get confirmed with the big chart, that's something we'll pay more attention to. Or if we weren't in what we call the slide, well, this time of year is just the time of year, like we say, sell in May and go away. It's the sort of sliding sideways time of year. It's the up and down, the choppy time of year. It's not the time of year that amateur traders like to trade. Now remember, what's the difference between an amateur trader and a professional trader or investor? Professionals have to invest. Amateurs are able to pick and choose. We don't have clients we have to satisfy. We don't have accounts we've got to manage. We simply have our own money that we're looking at. And the nice thing about that is when we have to trade, when we want to, and when the getting's good, as they say down south. Now we can see that again we are below the 2-day trend line on the 4-hour chart, crossed over going down. Derivative oscillator is also falling off. So keep that in mind as the market opens on Tuesday morning, the 16th. Let's go to the Qs, range back out to the 2-day chart and see what we see. Well, we've drawn a nice trend line connecting 3 downward moving candles on the 5th, the 9th, and the 15th today. That is Monday as we go into Tuesday. We had a bit of a doji on the candle in between those. That is on the 11th of June. And what do we see there? Well, a doji, as we always talk about, indecision. It shows you massive indecision in that index. And what happened? Well, the market was digesting what it was going to do, and it chose to keep moving down and follow the the 2-day chart. So we are in an even more accelerated down move at this point with the derivative oscillator and a widening in the difference between the signal line and the MACD, which means more and more of a divergence. Now, if we go and we look over on the cues to the 4-hour chart, what do we see? Well, on the 4-hour chart, we see a move below the 2-day trend line. We see a large down move in the morning, a little bit of recovery in the afternoon. Overall, the cues was down 0.5%, half a percent for the day. So that is where we stand with our 3 indexes. Now, let's range back out on the 2-day chart. And lastly, look at gold. What do we see happening with gold? Well, if we look where gold has been all the way back to April the 6th, we see where it topped out, started sliding sideways through May, and then moved up a little bit around May 14 and May 18 on the 2-day candles, and then rolled back over again. It is technically, right now, gold is technically in a down move, having crossed over the moving average convergence divergence, the MACD, between the 26th and the 28th, and it has been in a downward movement since then. It does appear that the MACD could be coming together. It is converging. We don't know that it's going to cross going up yet, but it is converging. The derivative oscillator, which on our charts look like light red or light green rectangles, above and below the 0 line, we can see that it is losing speed as far as in its down move goes. The derivative oscillator is still red. The 2-day chart is still in the red, that is going down on the MACD for gold. But gold has moved up a little bit. It had a green candle moving up on the 9th of June, another one on the 11th of June. Today it ended with a small red candle going down. The bulls pushed gold up considerably during the day, but the bears pushed it back down, and it closed actually lower than it opened on the 2-day candle. Now for the day it's up 0.44%, but again, we're not looking at a daily chart. We're looking at a bigger chart, twice that size, the 2-day chart. Let's drop back and see what we see on the 4-hour chart, and if that helps us at all. We can see that the 4-hour chart crossed over going up between the 9th and the 10th, and we saw that the derivative oscillator and the MACD crossed over about the same time. A strong up movement the morning of the 10th, and then sort of a falling off. And even as it ended today, that is Monday, the 15th, it still did not get as high as it got on the 10th. So again, what do we go by? We go by the bigger chart, and until that bigger chart changes, we continue to watch it, and that is our chart for trading. Again, gold has been slipping sideways for quite a while. If there is a huge catalyst that changes gold, and we see the derivative oscillator, which is not too far from crossing over going up. I'm sorry, not the derivative oscillator. It also might not be too far from going up, but the MACD, if it crosses over going up, then we do have a change of circumstance. That's when we would call gold in an up move. That has not happened yet. That is where we are as far as the end of the day on Monday the 15th going into Tuesday the 16th. We hope that you have a great day investing and trading in the market, a great week. Thanks so much for joining us. We love you to follow us at chartingwealth.com. We love to hear from you. You can follow us on Facebook and on Twitter. We love your questions, comments, concerns. Please let us hear from you. chartingwealth.com. Thanks so much for joining us.